Hello, everybody. I had a really interesting comment from an old friend who reached out regarding one of our previous videos about investing. And they posed this interesting question. I'm going to kind of read what their comment was. They basically said, convince me why I shouldn't just keep investing everything in stock. They said, I've always seen people recommend a split between stocks and bonds, and I totally understand the purpose of it, but it still seems that I'd actually be better off, paraphrasing here a little bit, if I went all in on index funds in equity and stocks. It's already diversified amongst thousands of companies, and over the course of 100 years, it's proven to be very reliable. They continued to say here, I understand the stock market can dive down. I remember 2008, but since I've got a couple decades before I need to use that particular money, that's okay with me. I can ride out the major dips. Seems like whatever portion I put in bonds will just guarantee earning less overall. So there's a lot packed into that question. I think it kind of boils down to historically, if stocks seem to always outperform, why should I ever own bonds? So let's explore that question together. All right, guys. So the big question is why or when should I ever use bonds? Why not just always use stock? So let's go over a few notes related to that, and then I want to show you some spreadsheets that I built to kind of illustrate some of these points. First of all, stocks do historically significantly outperform over long periods of time. I'll show you some examples of that here in just a minute. So the big question, why bonds? Like, why ever, right? One of the big reasons why is what is sometimes referred to as sequence of return risk. This is the idea that the returns that you receive in the marketplace aren't smooth and aren't equal from year to year. So while over long periods of time, stocks may far outperform or historically have far outperformed fixed income securities like bonds, the reality is those returns don't come in a smooth, even every year predictable pattern. They go up a whole bunch, then they go down a whole bunch. They go up a whole bunch, they go down a whole bunch. So that sequence can matter a lot depending on when you need the money. You can have a whole bunch of really good returns and then have one really bad year right before you retire or right after you have retired or right when you need to get access to the money that you've been saving up for and investing over the long term. And that's the kind of thing that you got to watch out for. So sequence of return risks. Order of returns can't be controlled. The order matters a whole bunch. Bad returns right before you need the money or early in retirement can be really bad news. So the next consideration is this, the time horizon rules of thumb. So in other words, how long do you have before you need the funds back? When you're investing, it's not just, everything's not on the same time horizon. Like someone might not be retiring for 20 years or 30 years. And the reality is even if they're retiring in a week, they may need to have their portfolio producing income for like 25 or 30 years after they retire. So that's something to be aware of. There's this kind of like time horizon over which we need the funds that we're investing and that we're saving, that we're accumulating, and that matters a lot. So on a shorter time horizon, you might do things a little differently. I've got some basic rules of thumb here. This is what I like to do, what I like to follow, and what I like to recommend. Basically, if you need funds, if you need cash in the next year, you really probably shouldn't have it locked up in securities like stocks. Most likely, it's going to be best suited to have those funds in checking, maybe in a high yield savings account, and you can pull the funds out as you need them monthly or quarterly into your checking account. So, looking at this next bullet point here, what if you won't need the funds for a little bit longer time frame, like 2 to 5 years? In that case, I think you could probably use fixed income securities. So you may be able to find bonds or CDs, and you can even create a ladder of those funds and say, well, I need part of those funds in the next 6 months, part of them 6 months after that, part 6 months after that, and so forth. And you can actually ladder out CDs or bonds that expire or that mature rather, kind of corresponding with your timeline. And that's one way that you can get some additional yield potentially. It's always good to look at things like bonds and CDs, sometimes even something called a MYGA, which is a multi-year guaranteed annuity. That's kind of a relatively, maybe underutilized product. It is an annuity, so it has all the background baggage that people think of with annuities, but a MYGA is basically just a fixed income product where you'd buy an annuity that would be locked in for 2 or 3 or 4 or 5 years, and then it would allow you to have a certain guaranteed income return. You couldn't access it before that time period, but it would basically lock those funds up for a short period of time, 2, 3, 5 years, and then you get a fixed rate of return in exchange for that. So that's another option. Most people will use bonds and CDs. bonds are very liquid, so you could sell them if you need to get to them, or a bond fund would allow you to sell part of that off if you needed the money before that. But if you know that it needs to be set aside for a few years, it may not hurt to lock it up and try to get a little bit higher return. Okay, what if you won't need the money for more than 5 years? That to me is kind of the tipping point. I'd say that sort of 5 to 7 year window is when I'd say, before that, probably need to be more fixed income securities. When you sort of hit that point of 5 to 6 years, that's the tipping point where maybe some of it should be in bonds, some of it should be in stocks. If it's funds that you won't need for longer after that, you won't need them for 7 to 10 years, that may make more sense to have those particular funds in stocks. So just you have more time for the market to do its thing. It's entirely possible that over 5 years you could have, a tanking in the market and not have time to recover. But as you start to stretch that time frame out closer to maybe 10 years and beyond, you're more likely to have the timing of the market with a full market cycle within that time window. What if you don't need it for more than 10 years? Well, at that point, if you don't need it for 10 years, 20 years, or 50 years, or whatever, at that point, you might as well just fully invest and just get your fair share of market returns over the long term and be, more fully invested in just stock. So those are kind of the time horizon considerations. Let's take a look at kind of emotional and behavioral rules of thumb. So what do I mean by that? There's this concept, you've all heard of this, I'm sure, of behavioral finance. It's kind of a hot area right now to study and to research that's looking at the brain and the psychology of decision making and how it impacts things in the world of finance, personal finance. Um, my wife and I actually both have our undergraduate degrees in neuroscience, and I studied for a little while in neuropharmacology. So before I went into the world of kind of business and investing and law and financial planning and all this stuff, my background before that was actually in more of the kind of medical healthcare and psychology and neuroscience areas. So this is an interesting area for both she and I. But let's talk a little bit about the psychology of losing. So, big picture, fear tends to be extremely strong in both directions. So, fear of further loss, if you've already lost some in your portfolio and you're concerned that you might lose more, or fear of missing out on possible additional gains. So, what do I mean by that? Well, maybe the market's done really well and you've been sitting on the sidelines and you think, oh man, it's gone up so much, or think of Bitcoin shot up so much, and a bunch of people were like, "Oh boy, I need to probably get in on that crypto." The reality is, though, a lot of people get in after a big run up has already taken place because they see it going up and they're worried it's going to go up more, and they're going to be on the sidelines still. The interesting thing about doing that is that psychology of fear, responding to the fear of losing more than you've lost or of missing out on more than you have missed out on, tends to get people buying high and selling low as opposed to buying low and selling high. So the psychology of fear oftentimes motivates us to do exactly the opposite thing, the exactly wrong thing from an accumulation and investment standpoint. It's interesting that actually some research suggests that the average investor actually underperforms most major asset classes. That's kind of shocking if you think about it. It would be better in most cases to just buy almost anything and just sit on it for a whole bunch of years and not do anything than to try to respond to the fears and emotions of being a normal human being, where we have all these fear responses triggered in our brain and we may freak out about things that happen in the marketplace. So it's just an interesting reality that in a lot of situations, the average investor actually underperforms simply because of emotional responses and behavioral responses. Behavioral responses. Um, what does that really come from? Well, we kind of talked a little bit about it, but a big part of that is just due to judgments and emotions. So if you see a situation and you become emotional about it and you start to have that natural fear response, oftentimes what you do is the exact opposite thing, which can lead people to underperform even just basic strategies of hanging on to any old strategy or any old asset class for long enough. So while it's true that having bonds will limit your upside, at least historically, bonds have underperformed stocks. So if you have any portion of your portfolio in bonds, it's going to tend to, historically at least, it would have tended to lower the return profile of your entire portfolio. But there are several benefits to bonds, which include things like general stability of the portfolio, smaller market swings, less emotional roller coaster. It sort of adds a ballast and a stabilizing influence to your portfolio so that you don't have as much emotion tied into the changes and things that happen because they're more gradual. There's less fluctuation. The other thing that's big about bonds is that there's more certainty of income. So another thing to think about with that is that you can have more certain results. You can actually set up like a bond portfolio that's laddered out or a CD portfolio that's laddered out, and you know from day one what the promised rate of return is, or what the projected rate of return is on the day that you buy the bond, or the guarantee from the bank on what interest rate they're going to give you over the period that you're holding that particular product, the CD. And that allows you to know from day one what your return will be on the other end. That's really helpful over shorter time frames in particular, when you may not have the flexibility of riding out the waves and the storm for a longer period of time in the greater stock market. Something interesting to know too, just keep this in your back pocket. Many big institutions, like major financial institutions, some of the largest portfolios in the country and probably in the world, are those portfolios that belong to big financial companies like insurance companies and pension companies, um, and pension portfolios, pension plans. And a lot of those big companies that have an obligation to make good on certain payments at certain time frames, like on annuities that they're backing, or life insurance policies, or even property and casualty insurance companies. Anybody who might have to pay a big claim out and who needs to have some stability in their portfolio because they're not exactly sure when or how much they're going to need to pay out. So to do that, oftentimes these companies will actually invest in gigantic bond portfolios. They may have other segments of their portfolio that are invested in private investments and in equity investments, stock, private equity, private debt, even some of those other things, real estate. But oftentimes those big institutions will utilize large professionally managed bond portfolios just to manage the certainty factor that they need to have in backing their own products. So one lesson we can take from that is that if the big boys are using bonds, and they're very well informed, very well educated, and they've got all the resources in the world to research, maybe there's a place for that in our portfolios as well. Now, I'm not going to push super hard on that in certain circumstances. So, in fact, let me just scroll down here a little bit. There are a few exceptions to when maybe it makes sense to have bonds in your portfolio. In my opinion, realistically, if you're in a situation where you're never really going to run out of money, you don't really need to worry because you've got far more in your portfolio than you're ever going to draw down in your lifetime. Then maybe you don't need to worry quite as much about stability. Maybe you have the financial capacity to actually take more risk. Just as an example, let's say someone needs $150,000 a year from their portfolio, but they've got a $10 million portfolio. Just doing a little bit of math, $150,000 divided by a $10 million portfolio. That is a 1.5% draw on that portfolio annually. That's pretty low. That's a very low standard of return that they have to meet in order to meet or exceed the income that they're drawing down from the portfolio. In that case, more money, more capacity to take risk, then it becomes almost just more of an emotional thing. If you emotionally can handle the waves and the roller coaster, financially, you're probably going to be just fine. Another exception to when to own bonds, or the idea of owning bonds, may be that you have income streams that cover your expenses and you won't really need to access your portfolio for income anyways. So basically, if you might have an investment portfolio, but maybe you own a bunch of rental real estate, or you've got some passive interest in a business, or you own enough stock that's dividend paying that you can just live off of the income stream that's being produced by that. You don't need to ever liquidate the portfolio itself. If that's you, then it may be the case that you don't need to really be as conservative. You may have the ability to sort of shoot for the moon because you're probably going to be okay anyways. So if you've got funds outside of your investment portfolio, resources outside your investment portfolio, maybe you're a beneficiary in a big trust from your parents or grandparents or something like that, that might also put you in a situation where your own investments could be relatively risky because you don't have a lot to lose. The other thing that we kind of mentioned earlier too is if you have just a really long time horizon, like 10 plus years, or even if it's much longer than that, 15, 20, 30, even 40 years. And I'm not just talking about to like right now to retirement, but maybe from right now to the end of your life. If you're in your 40s or your 30s or your 20s, you're likely going to be alive in 20, 30, 40 years, potentially even 50 years in some cases, right? So thinking of that, you have a long time horizon. You want your funds to last, and you probably have the bandwidth and the runway to afford to be able to take some risk in your portfolio. At that point, if you fall into any of these exceptions, really the decision about whether to have bonds or how much bond exposure to have in your portfolio is more of an emotional and behavioral management thing. It really comes down to maintaining a ballast, and can I minimize those swings? So instead of being way up here on my ups and downs, maybe I'm kind of bringing those in just a little bit, just to give me a better chance of being able to ride those journeys up and down and not feel as rocked or as emotionally disturbed. And that staying power really helps you be more successful. Because remember, a lot of this is literally about managing emotion. remember that fear is like the worst thing for a portfolio. Changing portfolios emotionally, changing portfolios because you're afraid of what has happened or what you think might happen. Any kind of anxiety like that oftentimes is changing in the wrong directions, and it's just moving things around, which has transactional costs, but also often puts you in a position of buying high and selling low, as opposed to buying low and just gutting it out and keeping your head down and sticking it out through the storm so that you can participate on the upside in your fair share of market returns. Okay, so let's do this. I want to shift now to another document. I'll bring that onto the screen here. Let me just share this one. All right. So what I have here is some historical market data just to sort of back up a lot of what we've been talking about here. What I have is data going back to 1928 all the way through 2022, and it has S&P 500 including dividend returns compared to U.S. Treasury bonds, what the returns were on an annual basis. So this is the annual investment returns. What I have here in the left column, you can kind of ignore that. This is just a randomizer. So basically, if I select all of these and click okay, we just generated another year. Where is it? Okay, randomly selected 1954. In that year, there was a really good, super high equity return, 52%. That's just extraordinarily high. And there was a 3.3% return on the bond side of the universe in that year. So just to give some perspective, what I've got here is who won in each of those years. So if we scroll down the right-hand side, you can see everything in blue is when bonds outperformed stocks in a particular year. So I'll scroll down. There was clusters of years when bonds did really well, and then long stretches when stocks outperformed, bonds a few there, bonds a few there, lots of stock, a few years of bonds. Kind of goes back and forth a little bit. But let's summarize what some of that data actually looks like. So I'll zoom in on this just a little bit to make it a little easier to see. Between the years 1928 to 2022, through the end of last year, that was 95 different years. In those 95 years, 35 times bonds, quote unquote, won. They outperformed stocks. And in that same time frame, 60 times stocks outperformed bonds. So about 2/3 of the time, a little bit less than 2/3 of the time, stocks won. About 1/3 of the time, bonds won. But that's not the whole story. It's not just about who wins more often, right? It's also about how big the wins are. So just for some additional perspective, looking down here, if someone invested $100 in stocks at the beginning of this 1928 time period and just left that $100 there and just reinvested it every year and did nothing with it, nope, didn't add any money to it, didn't take any money out, over the course of those 95 years, they would actually have a portfolio of $624,534, compared to if you invested that same $100 in bonds, you'd have a current portfolio value of $7,007. So overall, the return on investment for the stock portfolio on average, the compound average return over that time period was 9.6%, and the compound return for bonds was 4.6%. So let me zoom back out here. That's just some perspective to back up what we already knew, what we'd already seen. Now let me just talk a little bit about sequence of return. So what I did over here, and we're going to focus in on this. Let me zoom back in. What I did here was I generated 10 years of randomized returns from that historical time period, looking backwards from 1928 to 2022. And then I randomly selected, each year I generated a new randomized return from selecting from that group, and then I put it in order here. So what we came up with was a market return in the first year of minus 10.5%, followed by positive 32.5%, and so on. So a win, a loss, a big win, small gain, pretty good gain, strong gain, pretty good gain. So all of these things are in order as they were randomly selected from our sample on the left. What you can see is there's 1, 2, 3 down years. There's 1, 2, 3, 4, 5, 6, 7 positive years. So we can see about 2/3 of the time, or 70% of the time, there was positive returns in the stock market, and there was about 1/3 of the time, or 30% of the times, when there was negative returns in the market. Okay, so let's just look at this. This is if you were fully invested just in the stock market and you didn't have any exposure to bonds. What would that look like if you started with $1 million, you got this return? What would the end balance look like? And then let's say that you're in a position in your life, maybe you're in retirement where you're starting to draw income off of your portfolio. So what I assumed was a 65,000 portfolio draw that is being used to supplement your income. So maybe you've got Social Security, but you're also drawing additional funds from your retirement portfolio for the sake of uh, augmenting your income needs. This would be like 6.5% draw on your portfolio, which would honestly be pretty high. But just for the sake of illustration, we ran this over 10 years just to kind of see what that would look like. So the end balance after year one would be $830,000. Start with $1 million, you lose a little bit in the market, and then you draw some additional funds out while the portfolio is already down because you need to use it to supplement your income. And you can see that every year the 65,000 grows a little bit. It's growing by inflation. So I grew it out at 4% per year. This increases by 4% per year just to sort of have an estimate of keeping up with inflation. Well, over 10 years, what you would end with is a portfolio of $633,000, even though you'd had more wins than losses in your portfolio. And that's not because the market wasn't performing well, but because the market was doing what it's going to do, and you were drawing funds out to fund your portfolio needs. So this is another reason that sometimes people will use some bonds in their portfolio. It can create income streams. It can create some stability, takes the edge off of the swings. And when the market's down, you can actually take funds more out of the bond side of your portfolio than out of the stock side of your portfolio to give it time to recover instead of having to take it from the stock side, the growth side of your portfolio while it's already down. Let's compare that to another example here where I took the exact same market returns, but I ordered them instead of randomizing them. I ordered them from worst to best. So if you had the exact same market returns, but in a sequence where the worst came first and the best came last, just notice what this does to the portfolio. Whereas above here, we ended this 10-year period with $633,000. We have the same portfolio draw that we showed above. So $65,000 increased by 4% inflation each year. In this case, this person actually runs out of money sometime during or after year 8. So they have some funds at the end of year 8. By the end of year 9 and 10, they're not going to have funds anymore. They're in the negative, which you can't have negative dollars, right? This is just sort of showing mathematically what would happen, but really they'd run out of money before they reach the end of this 10 years. So what happened here? Well, what happened here is what we described earlier as the sequence of returns risk. If you have market returns that are more negative early on in your retirement or closer to the time when you actually start to draw funds out, and that means your portfolio is down and you're taking funds out of the portfolio, and those two things don't mix very well. If you had 20 years and the market was down, you could just wait it out. The market would go down, it would go up, it'd go down, it'd go up, and over time you would hope and expect, based on historical performance, even though you can't guarantee the past will be reflected in the future, that historically you would have a higher degree of confidence that you'd have a positive overall return over the long term. Whereas in this situation, if you're pulling funds out, you don't want to be pulling it out while the market's down. So let's just continue with our discussion here a little bit. Let's say, just to kind of key in on this a little bit more, let's say that someone had, let me scoot this over a little bit. Let's say that someone had $50,000 and they needed $60,000, but they had a time horizon of about 5 years. Okay, so on the top, let's assume that they invested their funds relatively conservatively. We're just going to assume about 4.5% per year in a bond portfolio. And let's say that they've got these laddered out, so they have a high degree of certainty that they're in fact going to get about 4.5% per year from now until the end of their portfolio. So they have a lot of certainty about that outcome. Maybe these are CDs, maybe they use multi-year guaranteed annuities. There's other products they could use. But the idea is that they're choosing fixed income because they know they have a relatively short time period during which they need the funds. They need their 50 to become 60. So what happens? Well, at 4.5% a year, that 50 grows to 52, and then to 54, 7, 9, and by the end of year 5, they have over $60,000, which meets their goal and helps them accomplish what they need to accomplish. Let's compare that to having a short time horizon, same objective, same story. Down here, I have 50,000, I need 60,000, I've got 5 years until I need it, but I want to try to roll the dice a little bit in the stock market and see what happens. So let's just say that they had 4 really good years and 1 negative year, 1 pretty bad year, okay, at the end of their window right here. So really close to when they needed the funds, which is the worst case scenario that we're trying to avoid when we're planning distributions and planning taking funds out of our portfolio. So let's say you start at 50, you get a 20% return, you end with 60 at the end of that first year. then you got 15% return, 10% return, 2% return, and then finally in that last year, you have a pretty negative return. So even though if you just sort of added these up, that's not how it works, but if you added these up, you got a 20, a 15, a 10, and a 2. This is all compounded. Like you've got significant returns here, right? So by the end of year 4, just to look at what that looks like, you have grown to 77,418. Do a little math here. So in that time period, in those 4 years, your portfolio has gone up 55%. That sounds awesome, right? That's what we all want. Big gains, big growth. The problem is you have one more year that you have to weather the storm, crossing your fingers, hoping something bad doesn't happen. And in that year, like we show on the screen here, if you happen to have a 35% loss, that actually takes you from this $77,418 down almost right back where you started to $50,322. So did you meet your goal of $60,000 that you needed in 5 years? No, you did not. This is the scenario that people are trying to avoid when they utilize bonds as a way to offset some of the volatility factors and manage time horizon. So I'd say time horizon is one of the biggest factors to keep in mind when we're trying to figure out how to invest our funds. Okay, let's look at one more thing here. Let me just zoom in on this a little bit here, just for some perspective. This kind of helps us to think through what it takes if we're willing to go all risk, what it takes to grow, what it takes to recover from a loss, and so forth. This is just perspective. This doesn't necessarily have to change anybody's viewpoint. But let's say that someone started with $1. Okay, this makes the math really easy. They start with $1 and they incur a 25% loss. Okay, they're invested in some aggressive investments and it's just a bad year in the stock market and they lose a quarter of the value of their portfolio. Okay, so now they've got sitting in their account 75 cents. They've lost a quarter. Well, what rate of return does it take for them to get back up to $1? Okay, it might seem on the surface like, oh yeah, well I lost 25%, so if I gain 25%, I'm back to square one, right? And that's not true. To go from 75 cents back up to $1, you actually have to have a 33% return. In other words, it takes more gain to compensate for a loss. It takes more gain to compensate for a loss. Okay, 25% loss takes 33% to get back up there. What if you were thinking, hey, I want to get from the dollar that I originally started with back up to $1.50? Right? I'm hoping to get 50% of my money over a long period of time. Well, if I start with $1 and I've lost 25% and I'm down to 75 cents, to get up to $1.50, I have to have a 100% return, which is extremely unlikely in any given year, particularly for the overall stock market. So what I would just suggest here, the takeaway lesson on this is that having some stability is important and evaluating a big picture on all the factors involved in your situation is really important. It's not just that stocks do better, so you should only invest in stocks. Generally speaking, be invested in stocks. Generally speaking, they have historically outperformed in the long run. But you need to look at time horizon. You need to look at how long I will need the money for, when I will start to need to take funds from my portfolio, when I need to get the money back. If you have those things in your favor, also the size of your portfolio and how much you'll need to draw off during the 20 or 30 years or 40 years that you're in retirement. So those are the kind of things to think about. And honestly, if you're in a position where you can take more financial risk, that's not necessarily a guarantee that it's the best idea to go just be all in on stocks anyways. I'm not trying to advocate against that. I'm a big fan of growth. I'm a big fan of simply just riding the market out, keep your head down, trust the market, get your fair share over a long period of time. But it's really important to be aware that there are some situations where emotionally it's a lot harder than people might think to have lost 30% and 40% of your hard-earned funds and to be worrying about what's going to happen tomorrow. Is it going to go down another 5%? Am I going to lose another 3%? Is this going to be a bad week, an up week, or down week? That emotion is extraordinarily exhausting. So for those who have kind of the emotional fortitude to say, don't care, not going to watch it, not going to listen to the financial news, I'm just going to put my head down, do my thing, and trust the market for the long term. Maybe that's someone who could do that would be better off investing more heavily in stocks as long as they have the financial capacity to bear the risk and not put themselves at risk and at danger of being in a bad position because of the sequence of returns. So sequence of returns, emotional sort of fortitude and dynamic and sort of makeup of your own capacity and how you think financially. Those are some of the big things, and time horizon. So I hope this has been helpful. Thank you for joining me today. Please check out our website at www.lightstoneplanning.com. Also, check us out on YouTube. Our channel is YouTube/at Lightstone Planning. We've got a lot of videos. We're just starting to build content out. We're a relatively new channel. You can expect to see more good things like this. Let us know in the comments below if there's something you'd like us to explore. If you have a question or something you'd like to hear more about, we'd be happy to look into that both on the investing front and even perhaps even more importantly, on the financial planning and tax planning front. Look forward to visiting with you more in the future. Thanks for joining me today.
If you found any of this helpful, please give us a big thanks by clicking that like, subscribe, or share button below. That really means a lot to us and it helps us out on YouTube.